Top 5 riskiest stocks I personally hold. That's what we're about to get into here today, folks. Okay, I'm about to run you through my 5 riskiest stocks, why these are my riskiest stocks. I thought this would be a very valuable video here today, running through the risk factors of these stocks. And, obviously, whenever you're going to buy a stock, like so many people get caught up into the reward potential, and that's great, right? But I thought this would be just a great reminder of the risk you take, obviously, when you go into making a position in a stock. And I thought I would make this video, and I might make another video later this week. Let me know if you guys would be interested in this video or not. But I was thinking about making another video, my top 5 least risky stocks, or my top 5 safest stocks that I personally hold. So if you're interested in me making a video like that later this week, let me know in the comment section. I can certainly make one of those. I thought that might be intriguing as well. Okay, so yeah, we're about to get into all these different risk factors in today's video. Hope you enjoy this. Hope you get some real good value out of today's video. I appreciate y'all being subscribed as always. And, before we get into all 5 of these stocks and what makes them so risky and those sorts of things, right? And by the way, I got a free new workshop for you guys. This will be pinned comment down there. Make sure you access that when today's video is over. It's 5-part. It's absolutely free to access that. I think you guys should get a tremendous amount of value out of that. Investing foundations, okay? I think it's very important everybody understands math, okay? Not a lot of people understand how math works in regards to investing, and it's a crying shame, okay? When you go into a stock, and there's always a level of risk you have to take whenever you're buying a stock. I don't care what stock you buy, you are taking a risk. You are buying Apple stock, you're taking a risk. You're buying Microsoft stock. Like these are seen as like the safest stocks, right? Usually in the market. Even those stocks are still a risk, right? You buy the biggest bank out there, JP Morgan, you're still taking a risk. I personally own JP Morgan stock, by the way. You put money in an index fund, you're taking a risk. Everything when it's an investment, it involves risk. And it's important we understand that risk, right? Now, the great thing is when it comes to individual stock picking, and the most you can ever lose on a stock is 100%, right? But the most you can make on a stock is infinite. You can make 500%, 300%, 1,000%, 2,000%, right? And, if we look at the public count over time, for instance, right? And I sold most of my Tesla shares over time. This is all I hold in Tesla. Like, there's a reason I call Tesla, this house, I call it the house that Tesla built with the 20-foot ceilings that makes an 85-inch TV look like it's a little Cracker Jack box TV over there. People always dog on my TV. That's 85 inches. You don't want a 20-foot ceiling? That's what it looks like, okay, folks? That's what an 85-inch TV. It looks like a little iPad up there. That's just the way it is, okay? But Tesla definitely changed my life. Like, I still probably wish I did hold all the shares I used to hold, but I held so many shares. Like, people have no clue how much money that stock really made me, right? Elf Beauty, another great example. I used to hold like 10,000 shares of Elf Beauty, right? This one certainly was a game changer for me. Not as much of a life changer as Tesla, but here's the deal. $7,200 worth of these shares, and those shares are now worth $133,000, right? So sometimes it can go really good, and sometimes it can go really bad, right? The Chef is a great example of, I didn't lose 100% in that stock, but I lost pretty dang close. It was 90-something%, right? It was a absolutely brutal loss. And so when you're finding companies, right? And remember, when I was buying Tesla back in the day, it was a very risky stock. It had a pretty bad balance sheet. For my standards, it had a bad balance sheet. There was a lot of people thought they could go bankrupt. There was a lot of thought that Elon Musk wouldn't be able to pull it off. And, I assessed the risk and I took a level of risk, right? Same exact thing with Elf. I saw a company there that was very damaged. It was a very heavily beaten down company. And I thought, based upon what I was seeing out there in the marketplace, that I believed they were going to turn around. And certainly they did. And we're sitting on, ridiculous gains. And imagine all the profits I took from Alpha over time. Like, it's absolutely astronomical, right? But the one thing you got to understand when you're buying any stock that is more of a risky stock, right? You got to ask, is the business model there? But also, are you going to put too much money into it? Because what happens to some folks is they think they found the next Elf. They think they found the next Tesla. And what happens is they put too much money into a stock, right? And that's obviously can lead to a pretty bad situation, okay? All right, so let's talk about my top 5 riskiest stocks I personally hold. My 5th riskiest stock I hold is Fubo. Fubo is my 5th riskiest stock. Obviously, it's had a tremendous past 6 months. Stock's up 133% in the past 6 months. It's doing amazing right here recently. It seems like it's turned a corner, but still comes with a lot of risk, okay? Here's the deal. Fubo obviously pitches it as, hey, we're making great progress toward our 2025 profitability goals. That's great. They raised their forecast as of last quarter. They reduced their net loss by $41 million. Record ARPU in North America. That's great. They're making a lot of progress, but at the end of the day, Here's the numbers, okay? Their net loss from continuing operations last quarter was $54 million. Now, they should likely get that under control more and more over the future quarters, but it's not guaranteed. It's still a $54 million net loss from continuing operations, right? Adjusted EBITDA was negative $30 million, and free cash flow was negative $75 million in this latest quarter, okay? So the bottom line is, Fubo's got a lot of work still to do. Have they made a lot of progress? Absolutely. Do they still have a lot of progress to make? Absolutely, okay? Because the bottom line is, look at this, okay? So as of the end of last quarter, they had around $300 million in cash equivalents, and restricted cash, okay? Which is a pretty good sum of money, but it's not if you're losing these sorts of dollar amounts, right? And so at the end of the day, it's very important Fubo continues to cut down on these losses massively. We need to see in 2024 small losses. I mean, very small losses. We need to see quarters where they only lose $10 million on the bottom line, $20 million, $15 million. We need to see those type of quarters. If we're seeing those type of quarters in 2024, I can tell you then we're looking really freaking good with this one. In 2025, we can start talking about flipping, the ultimate flipping to profitability, right? And so that'd be a great scenario, but at the end of the day, it's still very risky because, man, the company's still losing a whole lot of money. Now, how do they get there? Here's the deal, okay? Subscribers. They need to continue to attract a ton of subscribers. Based upon Google Trends data, they are attracting ridiculous amounts of subscribers right now, okay? We'll see what they put up for this quarter. They probably won't announce the numbers for this quarter until November, unless they pre-announce because something's so shocking in there. But as long as they don't pre-announce, we'll hear likely in November. My guess is we're going to hear some pretty insane subscriber numbers, and numbers much higher than even the company was anticipating, okay? We need folks that sign up for Fubo to sign up for more expensive plans, and then we need the ads business to kick in a major way. Ads business has been, not really growing the way it should be growing. They need to get that obviously taken care of over this next few quarters and get that really, that business should be outstripping the growth rate of the total company by quite a margin. So if the company in general is growing revenues at 25%, the ads business should be growing 30, 35, 40% with how much catch up they have to do in regards to that. Okay, so a lot of work to do in regards to that, and that's how they get to profitability. If you look at their plans, here's the deal, okay? This is where they really start to make money, when they can throw people over to these more expensive plans, right? People like myself that are signed up for the $100 a month plan, right? Because I like to have all the different channels, and especially for college football, I'm a huge college football fan. They put so many games on so many different channels. I need like the ultimate plan, right? So this is what it's about for Fubo. It's about just attracting customers and then getting them to do add-ons, getting them to more expensive plans over time, and obviously taking things from there. So overall, Fubo's showing promise. It's certainly showing that it could become much less of a risky stock in 2024 and 2025, but it's not there yet, right? And that's why I put it as my number 5 riskiest stock I personally hold. So yeah, that's Fubo. Alrighty, next riskiest one I personally hold, and this one is a hedge, okay? So that is something important to understand. This is a hedge, meaning essentially it's a way of me offsetting risk from my portfolios overall in case the market tanks in any substantial way. And that is SDAO. So I have some call options on SDAO as hedges, right? This is definitely risky because when it comes to SDAO, here's the deal. It's basically an inverse of 3x of the Dow Jones Industrial Average. So if the Dow Jones Industrial Average goes up in any substantial way, SDAO plummets, right? Now, on the flip side, if let's say there's a scenario where the market tanks huge, SDAO prints money in those sorts of scenarios because it's basically doing a 3x. So let's say on a daily basis. So let's say the market's down, 1.5%. SDAO should be up 4.5% on that given day, right? So yeah, SDAO can be great and it can be absolutely horrible, but it's certainly very, very risky. Now, if you're wondering, because I know a lot of people are curious, do they have basically an SDAO for the NASDAQ? And yes, they do. It's called SQQQ. And this is for folks that like to basically do the inverse of the NASDAQ on a daily basis, which is certainly a dangerous proposition. It certainly paid handsomely last year, but man, it's a dangerous proposition. Here's the deal, okay? Look at SQQQ this year, right? This baby started at $54. It's $18 here today. What is this? Walgreens stock? Holy smoke, is WBA? What in the flip and flapjacks going on? And this is funny. I saw this little headline on Google from February 8th, 2023. SQQQ inflows soar as investors bet against tech. Oh, man, if only those people knew what was actually coming. That was just a start. They thought, oh, it's, stocks, tech stocks rallying in January. That's crazy. It's going to go down. And then, man, whew, what a rough ride that was, right? So, nonetheless, folks, SDAO certainly very risky. One of the riskiest things I hold overall as certainly an ETF there. Okay. Number 3 riskiest stock I hold is Avant Brands. This is a 13-cent stock. Yes, 13 cents. And talk about doing absolutely nothing this year. The stock hasn't even made a 1% move year to date. We're 9 months in the year. Like, do something, Avant. Like, go down a bunch, go up a bunch, do something. Like, come on, man. You can't be flatlining on the year. Like, my gosh, it's just ridiculous, right? No, Avant's certainly a risky stock. I mean, I think some of it's self-explanatory. The stock's like 13 cents a share. Like, of course, it's a risky stock, right? Now, here's the deal with Avant, okay? Have they made tremendous progress in terms of their bottom line? Absolutely. But this is as of their latest quarter. They still had a net loss of nearly $400,000, right? And that might not sound like that much, but Avant's a super small cap company, so $400,000 is still a decent amount. That's great when you compare it to a $3.8 million loss at this time last year, but they still got a lot of progress to make here in flipping over to profitability. So it's still a money loser for now, right? The other problem is, right, when you talk about robust domestic, which is basically Canada, demand, and international demand, right, which is shipping product overseas, and this has become a big component of their business. The international business is a little more, I would call it foggy, to see like what are the long-term growth rates there? Is this sustainable? Like, none of us really know to a super high level in regards to this, no pun intended. So I think there's a lot more to learn when it comes to that international demand over time. And if the international demand gets hit in any substantial way, it's going to hurt Avant in quite a substantial way. And that could be a situation where their net loss obviously piles up, their revenues go down, something like that, and that's certainly a risk, right? Now, the other big risk when it comes to Avant is the market cap's teeny in this company. It's like a $30-something million market cap. So when you're dealing with these sorts of companies, you're not going to have the sort of governance, you're not going to have the sort of board of directors or executives of those companies that you would for a lot of the big companies, right? Now, keep in mind, big companies can screw up just as bad as anybody, right? Look at WBA. I mean, that's about, one of the companies you would think would have one of the best management teams and board of directors. They had Roz Brewer there, came over, she was a high-level executive of Starbucks. She used to be the CEO of, Sam's Club. Like, she had all this amazing experience, and she still failed her job, right? So just because you're a big company doesn't mean, you can't fail your job as well, even if you have great pedigree. Now, Norton has always seemed like he's got his head on straight with the company, and it doesn't seem like the type of guy to do anything shady, but you never know, man. You never know with these sorts of companies, so it is a risk factor, something I have to deal with, and that's why it's my number 3 riskiest stock I personally hold overall. If they can get to profitability quarter in and quarter out, and you can count on profitability of either hundreds of thousands of dollars or certainly millions of dollars on that bottom line, then it's a whole different game. Okay, then we're talking about Avant's not very risky at all. But for now, until they really make that flip happen, it's seen as definitely a risky stock. Okay, so my hope is Avant can keep growing like it's been growing and flip to profitability, and then become hopefully a giant in this industry over time. Now, my second riskiest stock I hold. This is another stock in this industry. They compete a little differently. This one's a little more retail focused rather than wholesale focused like an Avant might be. They also own their own brands and things like that, and that is the Planet. So Planet down about 4% year to date. Certainly a risky stock, another $100 stock. So yeah, it's going to be risky for these sorts of companies, right? Now, this just goes to show you kind of the risk of a company like this, right? Check this out. So I'm looking over their latest investor presentation, and it's a simple typo, but it's, embarrassing. It's embarrassing. So they basically have their second quarter, and it's supposed to be comparing 2022 versus 2023. And instead they put second quarter 23 to second quarter 23, which is not accurate, right? And so that's just one of those frustrating things you got to deal with these sorts of companies. Like, Apple's not making a typo like that. Like Meta's not making a typo like that. The Planet, I guess they will. Okay, somebody must have been enjoying the product too much when they went to put this presentation together. Holy smokes, okay? Now, also their cash as of the end of last year, right? Which this kind of bugs me why they put the cash at the end of the year, whether or not the latest quarter, like that doesn't make any sense. But anyways, they had about $40 million there, or maybe they just didn't change these numbers as well, which is certainly a possibility. We'll see maybe in the next slide. But they had $40 million. I can guarantee you that number is likely lower now based upon all the money they've spent recently, acquisition, just cost in general, net loss, things like that. Okay, so here's the actual numbers for the company. And as we see, this is the latest quarter for 23, and this was 2022. So this should have said 2022 over here, right? So here's the deal. Revenues went down in the latest quarter. Gross profit went down in the latest quarter, and net loss went up substantially for the company in the quarter, right? On a year-over-year basis. Now, I believe that is the trough for the company. I believe, basically the business just gets better from here. That's my personal belief based upon what I've kind of heard and seen from pricing side. The business side in general, I believe this business troughed, and I believe every quarter kind of moving forward here for quite a while is going to be better and better and better, and they're going to be able to, hopefully flip that bottom line back around and also start having these revenues go up and up again, which will be certainly very, very exciting. Now, to add more confusion to the planet overall and why it's, unfortunately my second riskiest stock is they just bought this VidCan company, right? Or VitaCan, and they spent $4 million of cash. They're going to dilute shareholder value in regards to this. And I don't know what this is going to make for the financials. I just don't. I don't know. And so this is one of those deals I just kind of have to put my trust in management team, but I can't buy more shares of stock right now. Absolutely not, because I don't know, this might be a brilliant acquisition, and this might look back in 3 years, 5 years and be like, geez, man, what a genius acquisition that was by the planet to make that deal happen. But I don't know as of right now, right? This industry is not very clear cut, and this isn't like a big acquisition of some company that their whole history, and that's the problem with the planet. And we don't know, are they going to do more deals? Are they going to dilute shareholder value more, right? Or are they going to spend a bunch more of the cash to make it even a more risky stock? Because one of the great things about the planet over time has usually always been they have a great balance sheet. So you could question other things with the planet, but you can never really question their balance sheet. Well, if they keep doing acquisitions, their cash is going to go down in a substantial way. Or if their losses keep picking up, guess what? Well, their cash is going to go down substantially, right? And so overall, the planet, certainly a risky stock I hold, and that's why it's my second riskiest stock. Now, my riskiest stock I hold, this one's the most frustrating of the bunch, okay? It is. It's no doubt this is the most frustrating one, because here's the deal. This one should be among my safest stocks. It should be. But instead, it's my number one riskiest stock I hold in the entire stock market. The company sells diapers, wipes, soaps, lotion, shampoo, cosmetics. It should get no safer than this. But the company has been so mismanaged over the last couple of years that, it's shocking. It's shocking how mismanaged this company has been, okay? Absolutely shocking. It's the most frustrating stock I hold by a mile. It's not even close. It used to be the chef. This is my new most frustrating stock, okay? And this stock is honest. And honestly has been so frustrating to deal with this stock. One is it's a great year in the market, and so many of my stocks are just, having such a phenomenal year. And I got the honest company now 51%, pathetic, okay? But here's the deal with this company. So they just brought in a new CFO. Now, you might see this as, so Kelly Kennedy is stepping down from the company, right? Which, they kind of cleaned house there. They got rid of the CEO, obviously, at the end of last year and the beginning of this year. They brought in Carla Vernon, who, seems like maybe she'll have it going on, but we'll see, okay? I can't get too excited about any of these folks. But they kick out Kelly Kennedy. Well, she's stepping down. We'll call it that, okay? And they bring in this gentleman from Duluth Trading Company, right? Dave Loretta. And at first, I don't really follow Duluth, so I was like, okay, at least he has public company experience being a CFO, okay? And I looked at this company, I'm like, oh no. Here's the past 5 years for Duluth Trading. The stock's down over 80%. Are you flipping my flapjacks? They bring in this guy to be the CFO of the company? Oh my gosh. And of course, you can't pin this all on the CFO of the company, right? It could be many other things, and just, it could be the CEO's fault, it could be the marketing team's fault, and many other folks. But at the end of the day, it's not great to see a CFO incoming to a company whose stock is down 80% in the past 5 years. It's like, are we kicking out somebody who wasn't doing a good job for a person who does just as bad of a job? Like, that's the way I kind of think about this. Like, when I first clicked on Duluth, I was like, oh, please tell me this is a company that's been executing well over the last few years. And I'm just like, oh my gosh. Oh, it's honestly so frustrating. It's honestly so frustrating. Net loss for the company last quarter came in at $13 million. That included $1 million in costs related to the transformation initiative, compared to a net loss of $10 million in the second quarter of 2022. So basically net loss went up for the company overall. Balance sheet had about $18 million on it. So here's the deal, okay? Honest needs to honestly get their margins and bottom line fixed fast. If they don't fix fast, they will be another chef. They will face another, let's call it the depths of a bankruptcy type situation. Or they're going to have to try to dilute shareholder value, which is not going to be pretty when your stock's $1, okay? They need to fix things quickly. So Carla needs to work quickly and get this business in a right place fast. And there's no reason why she shouldn't, considering the revenues this company has coming in and the relationships and the partners this company has. I mean, they're close with a lot of the biggest, most important retailers you could ever want to be close with. So Carla better get it done and get it done absolutely quick. But yeah, that's my number one riskiest stock in the stock market. Who would have known diapers and wipes could be such a risky business? I appreciate everybody joining me as always. Thanks so much for being here, folks. Let me know if you want that top 5 safest stocks video. I can certainly put that together. I'll check comments. If I get enough comments that suggest a video like that, I'll certainly do a video like that for you guys. So appreciate you joining me. Much love as always. Hope you got some good value out of this, talking about the risk factors in regards to these companies. Make sure you check out pinned comment down there. Get my Investing Foundations workshop. That should help you out immensely. It's absolutely free to access that, and you're going to get a ton of value out of that. Much love and have a great day.